Avino Silver and Gold Mines is in a transitions from a single-asset junior producer to an intermediate mid-tier operator in Mexico. The company, which has maintained operations in the Durango region for over 57 years, is currently executing a 5-year growth strategy designed to triple its production assets through the integration of high-grade underground resources and the monetization of historical tailings. This analysis examines the operational, financial, and jurisdictional pillars of the company, contextualizing its recent record-breaking performance against the backdrop of a bullish multi-year cycle for precious and industrial metals. Strategic evolution and the transition to intermediate status. The fundamental thesis for investing in Avino Silver and Gold Mines rests upon its evolution into a diversified, multi-asset producer. For decades, the company's identity was tied almost exclusively to the legacy Avino Mine. However, the strategic acquisition of the adjacent La Preciosa property from Coeur Mining in early 2022 marked a definitive shift in the company's trajectory. This acquisition effectively increased the company's mineral property ownership in the Durango district by over 600%, bringing its consolidated mineral resource base to 371 million silver-equivalent ounces. The proximity of La Preciosa, located just 19 kilometers from the existing Avino processing facility, allows for immense operational synergies, as the high-grade ore from La Preciosa can be processed using the excess capacity of the current mill circuit, without the need for a massive greenfield capital expenditure program. The company's 5-year plan aims to move from 1 to 3 producing assets, which include the Avino Mine, the La Preciosa underground project, and the Oxide tailings project. This expansion is not merely a play on volume, but a sophisticated attempt to optimize the grade profile of the company's output. By integrating La Preciosa's silver grades, which are approximately 3 times higher than those currently mined at the Avino Mine, the company expects to significantly lower its consolidated all-in sustaining cost profile while simultaneously increasing total silver equivalent production. This transition is being funded through organic cash flow and a disciplined approach to capital allocation, keeping the company debt-free, excluding minor equipment leases. Operational resilience and the core Avino Mine. The Avino Mine serves as the operational foundation of the company, providing the cash flow necessary to fund the broader expansion. In 2024, the mine demonstrated remarkable resilience despite technical challenges. During the second quarter of 2024, the primary crusher suffered an unscheduled breakdown, which threatened to derail the annual production guidance. However, the operations team in Durango successfully mitigated the downtime, and by the fourth quarter of 2024, the mill was processing at a record-breaking rate of 181,733 tons, the highest quarterly throughput in the history of the company. For the full year 2024, the company produced 2,652,498 silver equivalent ounces, representing a 10% increase over 2023. This performance confirms that the existing infrastructure is capable of high availability operations when properly maintained and upgraded. In 2025, the operational focus shifted toward maximizing mill availability and managing the natural variability of underground mine sequencing. In the first quarter of 2025, the company produced 678,458 silver equivalent ounces, an 8% increase year over year, driven by improved grades in silver, gold, and copper. By the third quarter of 2025, mill throughput remained elevated at 188,757 tons, although total silver equivalent production of 580,780 ounces reflected a move through a lower grade section of the mine plan. This variability is a standard characteristic of epithermal vein systems, and the company's ability to maintain high throughput even during lower grade cycles is essential for spreading fixed costs and maintaining operational leverage. The metal mix at the Avino Mine provides a unique hedge within the precious metal space. While primarily a silver producer, the company derives significant revenue from copper and gold. In the third quarter of 2025, approximately 49% of revenue came from silver, 31% from copper, and 19% from gold. This polymetallic profile allows the company to benefit from both the monetary demand for gold and silver and the industrial demand for copper, which is increasingly tied to the global energy transition and electrification. The copper production at Avino remains unhedged, providing shareholders with direct exposure to industrial metal price increases without the limitations of preset sales contracts. The La Preciosa project, high-grade growth catalyst. La Preciosa represents the single most significant growth catalyst for Avino Silver and Gold Mines. Historically, the project was explored by Coeur Mining as a large-scale open-pit operation, but the feasibility studies at that time were marginal due to the lower metal prices and high capital costs associated with a greenfield mill. Avino's management team pivoted the strategy toward a high-grade underground mining model that leverages existing mill infrastructure, which dramatically improves the project's internal rate of return and reduces the environmental footprint. The development of La Preciosa has progressed ahead of the original schedule. In the first quarter of 2025, the company received the final environmental permits needed to begin underground development. By April 2025, blasting operations had commenced on the San Fernando ramp, and by the end of the third quarter of 2025, over 6,700 tons of high-grade mineralized material had been stockpiled. The trucking of this material to the Avino mill is currently underway, marking a critical milestone in the project's integration. Recent drilling results at La Preciosa have been exceptional, confirming the presence of bonanza-grade silver veins. For instance, hole PMLP 2503 intersected 7.90 meters of true width, grading 1,638 grams per ton of silver and 1.92 grams per ton of gold, including a phenomenal intercept of 15,352 grams per ton of silver over 0.37 meters. Other intercepts, such as 787 grams per ton of silver over 5.22 meters in hole PMLP 2506, continue to demonstrate that the actual grades encountered during development may exceed the historical resource estimates. The company is on track to contribute an additional 1 million ounces of silver equivalent annually from La Preciosa starting in 2026, which would represent a 35% increase in the company's total output. To further de-risk the project, the company successfully bought out all outstanding royalties and contingent payments on La Preciosa in August 2025. By paying $13.25 million upfront and committing to an $8.75 million deferred payment, the company simplified the project's cost structure and ensured that the full value of the high-grade production remains with its shareholders. This buyout makes La Preciosa essentially unencumbered, providing a clear path to enhanced margins as production scales up. Oxide Tailings Project, Economic Value from Historical Waste. The Oxide Tailings Project is the third pillar of Avino's expansion and involves the reprocessing of 6.7 million tons of material from historical mining operations in the 1970s and 1980s. A pre-feasibility study completed in 2024 outlined the economic potential of this initiative, which serves both as a production booster and an environmental remediation project. The study initially estimated an after-tax net present value at a 5% discount rate of $61 million, an internal rate of return of 26%. However, the rapid rise in metal prices has transformed the project's economics. Based on February 2025 prices of approximately $30.42 per ounce for silver and $2,763 per ounce for gold, the post-tax net present value doubled to $122 million, with the internal rate of return surging to 43%. The project requires an initial capital investment of approximately $49 million, but with an expected payback period of only 2 years and all-in sustaining costs projected at roughly $10 per ounce, it represents a highly profitable, low-risk addition to the company's production profile. By decommissioning the old tailings dam and processing the material through a modern circuit, the company not only recovers valuable metals, but also fulfills its commitment to industry best practices in tailings management. Financial performance and capital discipline. Avino's financial results in 2024 and 2025 have been nothing short of transformative. For the full year 2024, the company achieved revenue records of $66.1 million, a 51% increase over the previous year, while gross profit increased by 197% to $23.2 million. This financial strength continued into 2025, with the third quarter reporting record net income after taxes of $7.7 million, representing a 559% increase year over year. EBITDA for the same quarter reached $11.5 million, a 200% increase from the third quarter of 2024. One of the aspects of the company's financial profile is its balance sheet liquidity and lack of debt. At the end of the third quarter of 2025, the company held a record cash position of $57.3 million, with working capital of $51 million. This cash hoard allows the company to self-fund the development of La Preciosa and its extensive exploration programs without having to rely on the debt markets or dilutive equity raises during unfavorable market conditions. While the company maintains an at-the-market (ATM) equity facility to strategically raise capital at premium prices, it has prioritized organic growth through operational cash flow. The management of costs remains a focal point for the company as it scales. The all-in sustaining cost, AISC, per silver equivalent payable ounce was approximately $19.50 in 2024. In the third quarter of 2025, the AISC was reported at $24.06, an increase driven by the combination of higher silver prices used in the calculation denominator and lower byproduct copper credits during that specific production sequence. However, the company remains within its broader guidance, and the introduction of higher-grade ore from La Preciosa is expected to act as a significant deflationary force on the unit cost profile in the coming years. Market valuation and competitive landscape. In the context of the broader silver mining sector, Avino Silver and Gold Mines appears significantly undervalued relative to its growth potential and resource base. The company currently trades at approximately 1.2 times its price-to-net asset value, PNAV, while many of its mid-tier and senior silver peers trade at multiples exceeding 2 times. This valuation gap persists despite the company's record financial performance and its clear path to tripling its assets. Analysts suggest that as the company achieves its production targets at La Preciosa and proves the economic viability of the Oxide tailings project, a market re-rating is likely to occur. When compared to its primary competitors in the Mexican silver space, Avino's lean corporate structure and high insider ownership are notable. Approximately 4.3% of the company's shares are held by insiders, which is significantly higher than larger peers like Agnico Eagle Mines at 0.5%. While larger producers like Pan American Silver and First Majestic Silver offer higher absolute production volumes, they also carry higher jurisdictional complexity and often higher overhead costs. Pan American Silver, for example, has seen its silver segment AISC fluctuate between $14.50 and $16 per ounce, but its massive corporate overhead and multinational footprint differ significantly from Avino's concentrated, district-scale focus in Durango.
The inclusion of Avino in the VanEck Junior Gold Miners ETF, GDXJ, and its high ranking on the TSX 30 list for 2025 have significantly increased its institutional visibility. The stock has experienced a surge of over 325% in the past year, far outperforming the broader industry average of roughly 84%. This momentum reflects growing investor confidence in the company's ability to execute its transformational growth plan while benefiting from the record-high prices of silver and gold. Macroeconomic factors driving the silver bull market. The investment outlook for Avino cannot be divorced from the overarching supply-demand dynamics of the silver market. Silver is currently in its fifth consecutive year of structural supply deficit, with demand consistently outstripping mine production. This deficit is being driven by the relentless growth of industrial demand, particularly from the solar energy sector, which now consumes over 25% of the global silver supply. Projections suggest that solar demand could consume up to 98% of current silver reserves by 2050 if mine supply does not increase. Furthermore, silver's role as a strategic metal in the electric vehicle (EV) and artificial intelligence (AI) sectors is expanding. Data centers and advanced electronics are increasingly dependent on silver's unique conductive properties, for which there are no effective substitutes at current price levels. Because roughly 75% of silver is produced as a byproduct of lead, zinc, and copper mining, the primary silver supply is highly inelastic. Even record-high prices do not immediately lead to increased production because the economics are tied to other metals. On the monetary side, silver is often referred to as the fast horse of precious metals. It tends to follow gold's price movements with higher volatility, often outperforming gold during established bull markets. Institutional investment flows into silver ETFs have turned positive after years of outflows, and retail demand for coins and bars remains robust as investors seek a hedge against inflation and fiat currency devaluation. Leading financial institutions have revised their price targets significantly higher, with some analysts forecasting silver prices to reach between $70 and $100 per ounce by 2026. Goldman Sachs and JP Morgan have similarly raised their targets for gold, citing robust central bank buying and persistent geopolitical risks.
Mexican jurisdictional risk and regulatory reform. Operating in Mexico requires a nuanced understanding of the evolving legal and social landscape. In May 2023, the Mexican government passed significant reforms to the mining law, which reduced the term of concessions from 50 years to 30 years and introduced more stringent requirements for water use and community consultation. While these reforms created an initial thick smoke of uncertainty for the industry, established producers like Avino have been able to navigate the changes more effectively than juniors in the exploration phase. Avino's deep roots in the Durango community, dating back to 1968, provide it with a social license to operate that is difficult for newcomers to replicate. The company has maintained a presence in the same community for over 4 decades and is the region's largest employer. This long-standing relationship was instrumental in securing the land use agreement for La Preciosa, which required meaningful engagement with local community leaders and ejido members. While the new laws require companies to pay 5% of profits to local communities, Avino has long prioritized local economic development through direct job creation and support for local suppliers. The regulatory environment in Mexico is also seeing a reduction in the permit backlog, which had accumulated over the past 4 years. As of 2025, this backlog has been reduced by approximately 50%, signaling a more functional relationship between the mining industry and the Environment Ministry, Semarnat. Although some companies have left Mexico or filed legal claims due to the reforms, those that have stayed, like Avino, are adapting to a hyper-regulated environment that emphasizes environmental restoration and social responsibility. Exploration potential and resource expansion. Beyond the current production plans, Avino controls a massive district-scale land package that offers substantial exploration upside. At the Avino Mine, the Elena Tolosa (ET) area, ramp has been driven down to level 17.5, and the company is drilling to test the down-dip extension of the system. The Avino vein remains open at depth and along strike, with drilling continuing to show comparable grades and widths to the sections currently being mined. The 2025 drilling program at Avino consists of 9 planned holes from the surface, aiming to replace extracted resources and ensure a century-long mine life.
At La Preciosa, over 90% of the historic drilling was concentrated within just 10% of the total land package. This leaves vast areas of the property open for exploration, particularly to the east of the Martha vein and in several underexplored targets to the south and west. The company is currently conducting step-out drilling on the La Gloria vein to expand the known resource footprint. The high nugget effect and the pinch and swell geometry of the epithermal veins at La Preciosa mean that intensive drilling often reveals higher-grade pockets that were missed by wider-spaced historic drilling, a phenomenon already observed in recent results. The company also sees potential in the underexplored Guadalupe vein and other regional targets around the historic San Gonzalo mine. With a total of 7,746 hectares under control, the company is not only a producer but an explorer, with the potential to uncover entirely new zones of mineralization within its permitted corridor. This geological potential, combined with 53 million tons of material in the measured and indicated category, provides a solid long-term foundation for the company's growth ambitions. Peer comparison and competitive advantage. Analyzing Avino in the context of its peers reveals several competitive advantages. While companies like Endeavor Silver are often cited as the primary comparison, Avino's lack of debt and its self-funded growth model stand in contrast to Endeavor's recent $300 million convertible note issuance. While Endeavor offers high sensitivity to silver prices, its balance sheet is more leveraged than Avino's. Hecla Mining, as North America's largest primary silver producer, commands a significant valuation premium due to its low-risk jurisdictional focus in the U.S. and Canada. However, Avino's presence in Mexico, while carrying higher perceived risk, offers significantly more leverage to the silver price during a bull market. The company's AISC, while higher than some of the lowest-cost primary producers like Pan American Silver's Juanicipio stake, which operates in the $14 to $16 range, is comparable to other mid-tier peers in Mexico, such as First Majestic Silver, whose consolidated AISC has trended around $19 to $21.
The most significant advantage for Avino is its operational flexibility. The company is a price taker that remains unhedged, allowing it to realize the full benefit of surging metal prices. Its 2,500-ton per day mill facility is currently operating at only a portion of its potential capacity, and the integration of La Preciosa ore will allow for higher silver equivalent output without requiring the massive infrastructure build-out that competitors like Gato Silver or Silvercorp have faced. Risks and mitigation. Every investment in the mining sector carries inherent risks. For Avino, the primary risks include commodity price volatility, operational technicalities, and jurisdictional changes in Mexico. A sudden downturn in silver or copper prices would impact the company's margins, though its lack of debt and high-grade pipeline at La Preciosa provide a significant buffer. Operational risks, such as the crusher breakdown of 2024, are mitigated through continuous capital investment in standby equipment and infrastructure upgrades. The risk of regulatory overreach in Mexico is another factor, but the company's extensive history and strong community ties in Durango act as a powerful mitigant. The company's transition to dry stack tailings and its proactive alignment with new social and environmental laws suggest that it is well prepared for a more regulated future. Furthermore, the geological risk of declining ore grades is being addressed through aggressive exploration and the shift toward the higher grade veins at La Preciosa.
Conclusion.
Avino Silver and Gold Mines is currently executing a growth strategy in the silver mining sector. The company has moved beyond its legacy as a small, single-mine operator and is now a well-capitalized, multi-asset producer with a clear path to tripling its production. The integration of the bonanza-grade La Preciosa project and the monetization of the Oxide tailings project provide multiple catalysts for a significant market re-rating in 2026 and beyond. The financial performance of the company, characterized by record revenues and a debt-free balance sheet, provides the foundation for this expansion. In an environment of structural silver deficits and record-high metal prices, Avino offers a unique combination of established production, high-grade growth, and geological upside. While the stock has already performed well, it continues to trade at a discount to its peers based on net asset value, presenting a compelling opportunity for investors seeking pure-play exposure to the silver bull market. As the company continues to hit its production milestones and updates its reserve estimates, the gap between its current market valuation and its intrinsic asset value is likely to close, rewarding disciplined investors who recognize the strength of the Mexican silver corridor. The strategic vision of the management team, led by David Wolfen, has navigated technical and regulatory hurdles to position the company for a new era of prosperity. With over 57 years of experience and a century of resource life ahead, Avino Silver and Gold Mines is not just a participant in the current mining cycle, but a potential leader in the next generation of intermediate silver producers. The combination of high-grade assets, operational leverage, and a supportive macroeconomic backdrop makes Avino a compelling investment case for investors seeking exposure to precious metals.